Thank you so much for taking time out of your busy schedules today to be with us. My name is Melinda Cheel. I'm the Marketing Director here at RSF Social Finance, and I'm joined here by Don Shaffer, RSF's President and CEO. Hi, Don.
Hi all. I'm Melinda.
Hello.
Long time no see.
Yeah. So we have very much been looking forward to today's webinar, which is titled, If Not Wall Street, Then Where? So the plan for the next hour is for Don to present for about 25 minutes or so, which will leave plenty of time for questions. Please feel free to type your questions into the Q&A box at any point during the webinar, and we'll get to as many as we can at the end. You should see the Q&A tool in the control panel at the top left corner of your screen. Be sure to use that one rather than the chat box. I won't necessarily see them if it's a chat, so please use the Q&A. And before we begin, we're going to run just a quick poll to get a sense of who has joined us today. So let me get that up for you all. So would love to know if you're a current client, either investor donor or a borrower grantee, financial professional. And we currently have over 50 folks who've joined us so far. We'll give you another 10 seconds or so. Okay. Majority are financial professionals.
Great.
And quite a few who fit into none of the categories. You might have to think of another category. Okay, I think we're ready to begin. Over to you, Don.
Great. Thanks, Melinda. Look forward to speaking with you all and getting to the question and answer and kind of dialogue period as soon as we can. I'd like to set the stage by talking a little bit. You could go to the next slide, Melinda. So you'll notice these are not going to be dazzlingly complex slides. It's just sort of meant to prompt parts of what I'm going to say. I wanted to start first with the legal disclaimer prompted by our trusted in-house counsel, Tim Green, to say that this webinar contains general information and opinions only, mainly in this case, my opinions, and it does not constitute investment advice or an opinion on the appropriateness of any particular investment or course of action or solicitation to invest in any investment product whatsoever. So please consult your own legal, tax, and investment advisors before acting on any of the information. I hope the title of the session, if not Wall Street, then where, kind of implies that there's going to be like a prescriptive menu at the end that is like a magical way to just like hit return or enter on your screen and voila, you can have a portfolio. So that's not going to happen. And some of what I'm going to say is not going to be so much in the analytical side of things at all. So just want to prep you for that. I would like to start with just three statistics in the vein of setting the stage for kind of the rest of the conversation. And I'm not going to do too much editorial comment on these. These statistics come from a couple of editorials in the Wall Street Journal over the past couple of weeks. This first one comes from an editorial by Holman Jenkins from April 20th, 2016. The title of the editorial was "Big Banks Aren't the Problem." And he cites a couple of statistics that I just, are two of the three that I want you all to reflect on and can maybe research later. We can talk about. The first one comes from the Richmond Federal Reserve that tracks what they call a bailout barometer, quote unquote bailout barometer, that shows that since the 2008 crisis, 61% of all the liabilities in the US financial system are guaranteed by the federal government. That's a very large number, and it's up from 45% just in 1999. So that's something that I feel like is a important statistic, and so it's one of the three I'd like to cite. The second one comes from Citigroup, and they estimate that the top 20 advanced industrial economies, in addition to their very large public debts, also face additional debts to the tune of $78 trillion for their unfunded pension systems. So that's something that I think is worth noting as well. Again, I'm going to withhold kind of editorial comments. And then the third statistic is that it comes from a different editorial from yesterday called Ending America's Slow Growth Tailspin. And the writer's name is John Cochran. And in the first paragraph of his editorial from yesterday's Wall Street Journal, May 3rd, he says that from 1950 to 2000, the US economy grew at an average rate of 3.5% annually. And that since 2000, it has grown at a rate of exactly half that. And the editorial goes on to talk about the various reasons why that's the case, and what we may expect going forward. And so, as I said, I don't want to dwell on those, but I think it's important to note that we should all be trying to have context for our own personal investing approaches that has some tie-in to what's going on in the macroeconomy and the macro financial markets. But in terms of today, we're going to be looking, and in general, some of this is going to be based on my personal journey. Like, I'm looking to come less from the place of critiquing Wall Street going forward, and more from the space of solutions. And I'm trying myself not to be as strident or shrill in my critiques, and yet not lose some of the healthy fierceness of questioning assumptions. But I think of I think of a bumper sticker that I see sometimes in Berkeley, where I live, that says, "Don't believe everything you think." Which I think is provocative in a good way. And then there's another phrase that my daughter Sabine uses sometimes with me when I'm frustrated with her, and I might have a angry face, and she reminds me, more glitter, less bitter, Papa. So I try to pay heed to that. So anyway, let me touch on a couple of personal kind of anecdotes in a transparent way, and then touch on a couple other things before we get into the solutions. So we could stay with this slide still for the moment. So I first off want to acknowledge it's hard to move off Wall Street. We all have different motivations for why we invest, and I think for a lot of us, it's about wanting to earn returns, for financial returns for our retirement, for college, for any other savings reasons, rainy day reasons, et cetera, that are all completely valid, in each of our cases. And I just want to acknowledge that it's hard to go from, particularly for non-accredited investors, as I said in the webinar this fall, to do this. And I want to share for me personally, I had still, my family, we still have a mortgage with Wells Fargo. We had to move pretty quickly to buy a house in 2010, and there weren't, the local banks in our area didn't have mortgage products or good mortgage products. And so we have a loan with Wells Fargo that has since been sold, securitized and sold to Freddie Mac. And so I'm not happy about that, and And one of the themes here is around inertia, and I just haven't been able to get to switching that out, or making an effort to switch that out, because it's difficult to do so. Once but not that difficult. So so I should work harder at it. Another one that I'm super embarrassed about is that we have a United Airlines visa that's backed by Chase. And it had that for a long time, and so it's tied to miles, with an airline. And we're finally weaning ourselves off of that, and are intent on getting a B Corp visa with Beneficial State Bank in Oakland, which I highly recommend to others. Well, rewind the tape. Forget I said recommend anything, but that's what I'm doing. Is I'll just say it that way. And so there's some examples of my personal struggle with being totally consistent. I will say that I don't own any, me or family, we don't own any public stocks or bonds, and so we're kind of off the grid of the public markets. With that said, though, that includes my retirement account, but that our retirement account, but that the big caveat to that is that I'm aware that I make more money than my colleagues here at RSF, and so it's easier, for me to save more as a percentage of my income. And so, these are tough issues. I just wanted to share some of that. And then if we go to the next slide. I wanted to share in terms of owning public stocks and being part of the public markets or mutual funds, et cetera. Again, there are different reasons why we invest. We invest because we want to make money on our money, for things later in life or nearer term. Another reason to invest, of course, is to free up the capacities of entrepreneurs, and to see money going out in the world to enable good things to happen in the economy and just in the world in general. To that end, I did want to point out something that I'm always surprised that that more people don't know this, which is why I'm saying it. It may be redundant to a lot of you, especially the financial professionals on the phone. But the fact is that unless you buy, if one of your goals is to free up capacities of entrepreneurs and get them growth capital, when you buy a public stock or shares in a publicly traded company, you're buying those shares from someone else who already owns them. So you're basically trading, your money for their stock. Your money is not going directly to the company for growth capital. The only time that happens is when you put your money in at the time of the IPO. Beyond that, you're trading paper with other people that has value, but there isn't new money going to the company when you buy stock in Apple or whatever. And that's just something you should know. So, that's part of my personal, philosophy, and for us here at RSF is we want things to be as direct as possible. And when you're making direct investments into a privately held company, to enable them to grow or expand what they're doing in some way, it is a much more direct way of supporting that impulse, where you're wanting to your funds to help entrepreneurs. And so I want to point that out. If we go to the next slide, that relates to our approach at RSF, which is to focus everything we do, even though on the relationship part of money. So our entire focus is to help model transactions that are direct, transparent, and personal, based on long-term relationships. And I've said that, we've said that for a long time. And I'd like for part of this conversation to be about There's a lot of talk about social impact metrics and the analytical parts of investing and making sure one is being prudent with one's portfolio. There are many good reasons to be focused on that and to be smart about it. What I'm hoping is that more people will actually have the opportunity to be more embodied in how they're going about their investing, in seeking out, creating what we call here, to use Leslie Christian's term, which in turn came partly inspired by Judy Wicks, who used it for her book called Good Morning, Beautiful Business. And then Leslie picked up on it and has been using the phrase beautiful portfolio. And that the goal is, instead of getting your quarterly statement and seeing a bunch of numbers and sort of glossing over, glazing over and just looking for like, did it go up a little bit or down a little bit? You would actually take a level of interest in the statements and in general in your portfolio, because it was that much more direct and you could be that much more in contact with it. And so that's what she's calling a beautiful portfolio. And this would allow for someone that I spent some time with a couple of weeks ago named Gino Borges. He's using the phrase embodied investing. So instead of like always escaping up into your head around social impact metrics and all the analytical ways of looking at your portfolio or your investments, how can you be more embodied in your approach? And how can you, as much as possible, look at it as you're expressing yourself in the world through your money with various kinds of investments. Ideally, they can be as direct as possible. Ideally, you can have visibility to who's on the other side of the transaction, ideally be in relationship with them in some way. And then that sort of embodied investing, can connect to a more relationship-based approach to finance, which can then in turn lead to a healing economy. And by healing, I just mean that I think we all sense that we've been, extracting a lot from the earth for a long time. And we've also people have been getting exploited in various ways, in the economy for a long time. And my sense in a hopeful way is that this whole trend towards impact investing, regenerative capitalism, whatever you'd like to call it, is starting already to have kind of a healing effect on, what we call, the economy or finance or capitalism. And so that for me is kind of the goal. So with that, I'd love to talk a lot more about that, but let's just name that diversification is very important. I think that's really one of the few universal principles in any discussion about portfolio theory or what have you. And part of what I would sort of advocate here is it doesn't mean you need to leap into everything at once if you're seeking to have a beautiful portfolio. And so let's leave it at that. Let's go into some examples. So in no particular order, I'm showing these logos because I like to talk a bunch about the categories of investments they represent. And they're kind of apples and oranges. So this is where we'll spend the most time. I'm going to touch a bunch on these examples, and then we'll open it up for a conversation. One thing I'd like to share, our good friends Lisa and Charlie Kleisner at Tonic, and it's Tonic spelled with 2 I's, by the way, as it shows here in the logo. That came out of Tonic was created after the Global Impact Investing Network. So the 2 I's stand for impact investing, and I think you can follow that Tonic follows from gin. And hopefully you can follow the whimsical part of that. And Tonic's a network of high net worth individuals and families who are striving to go basically all in and be 100% impact oriented and mission driven in their investing. And they have been collecting impact portfolio data from the 100% Impact Network part of Tonic for a while now. And later this year, they're going to be publishing a report which shows an analysis of over 50 portfolios that have, quote unquote, achieved, 100% impact, where the person has said, I've got a stated goal to make the world a better place in X, Y, and Z ways, and I'm going to align 100% of my investments towards that. And that's a very subjective process, and you can learn more about what that means, in this report. But there'll be dozens of both inspiring impact investor stories, and there'll be over 1,000 investments across a whole range of different asset classes that are going to be showcased in these 50 plus portfolios. And I think it'll be the first time that something like this has come out. And I'm very excited about it. And I think that even though it's starting with high net worth individuals where there are more options and it's easier to create arguably 100% impact portfolio, I think it's a phenomenal place to start, and will be in advance, I highly recommend checking it out. So let's touch on some other examples of investments themselves. So we at RSF, we have $9 million in Solar City bonds here. It's the only thing that we're invested in that's publicly traded. And so we have done that because we feel like this is an imperative, shift that the world needs to make. We did a really thorough, analysis of where, if we need to participate in something that is with a publicly traded company as an exception, where could we do that in a prudent way, that also in a field building way to help kind of initiate and move something forward. So that's one example of what we've done. I'm going to keep things moving so we don't run out of time. We're also connected with a group called Dirt Capital Partners in New York. Jacob Israelo is the founder and principal investor there. He's developed a farmland and farm financing vehicle that helps farmers who are converting to organic or beyond organic practices to not only continue to be able to lease the land that but to eventually own the land that they're cultivating. And it's a phenomenal, Jacob's phenomenal person, entrepreneur, finance person, and this represents kind of like the leading edge to me of if you're interested in land and farmland in particular in this case. There are going to be more examples of this kind of fund coming online. Right now, this is reserved for accredited investors. So that's important to note with some of these. Another example, if you look at Organic Valley and Equal Exchange, these are two, in our world, bigger companies. I think, Organic Valley is about $1 billion in revenue at this point. They're a co-op of dairy producers, organic dairy producers all over the country. Equal Exchange is, about a $60 million revenue co-op in the Boston area that has basically pioneered, fair trade, organic supply chains for coffee and chocolate and other products. And they periodically are opening up non-voting shares in their company for all of us as investors, non-accredited, accredited, to participate in quote unquote owning a share of, say, Equal Exchange, but there's really no secondary market for the shares. They have been returning a steady 5%-ish return over, I think, the last 19 years or so as a dividend, annual dividend as part of those shares. And that's primarily, that's what you get. You're not kind of speculating on upside. You're more feeling like you're closely in touch with the company. and they make use of those funds to expand what they're doing, and you get what has been a very reliable return there. And same with Organic Valley. And I think there'll be more organizations, more companies, in this case they're both co-ops, more companies like this that are doing direct public offerings that allow a whole range of us to get involved in more direct investing with our values. I'm going to go a little faster here. There's a group at the Arizona Community Foundation that's developing a direct loan fund for social enterprises in Phoenix and greater Phoenix area. There are many, many more community foundations right now that are launching these kinds of direct loan funds, which I find to be very exciting and promising. Of course, many people know about Slow Money as a network of localized, investors who are focusing on food and agriculture related social enterprises. If you don't know about them, you need to check them out. Rising Tide Capitals in Newark, New Jersey, led by a phenomenal entrepreneur named Alpha Demolash, where they're essentially a form of incubator and accelerator, and then also coordinates capital for the entrepreneurs that go through their training programs and so forth. And I highly recommend checking out Rising Tide. And then WeFunder is a part of a large group of equity crowdfunding sites that are cropping up. And May 16th, coming up in just 10 days or so, is a big milestone for that, because the Jobs Act that was passed 4 years ago is finally now going to allow for non-accredited investors to make equity investments in all kinds of companies, but there will clearly be an impact investing part of this, of which WeFunder, we know Mike Norman and the other founders there, and we feel like this is going to be a very promising area, not without controversy or things to be careful about. And even though, as I said at the outset, we are not financial advisors, I would just say, diversification and, don't invest your life savings on day one in a small handful of, small privately held companies that you think are going to become the next Google, because they may not become the next Google. But by the same token, I think it's a very promising direction. So that's, if we go to the next slide, I can wrap up. So there's some examples of like where to start. And the theme here, I'll just say real quickly, is I would urge you to start somewhere. And a principle that we talk about a lot here is potency, not scale. It doesn't mean we're anti-growth in what we're doing at RSF. It doesn't mean that you shouldn't have an ambitious vision for what you want your beautiful portfolio to look like, that may have more direct investments relative to publicly traded stocks in it. But know that just taking one step, like just to put like, $50 in, equal exchange shares next year, whenever it becomes open again for investment, that has a tremendous amount of ripple effect in terms of you voting with your feet and allowing other people to follow in your footsteps. And the second principle is to find allies and support, because even though there's growing interest and awareness about impact investing, it's still early days. There's still too few options, especially for non-accredited investors, and it can be really frustrating to have the impulse to want to align your money with your values completely, and then not be able to find enough options. And so I think of our own retirement program here at RSF, our 401k, 403b program has almost exclusively publicly traded stocks as options. It's just, that's what kind of feel like we need to do right now. I mean, they're all at the deep end of the pool of ESG, but that's still the case. And unless you want to do a self-directed IRA, which is a longer discussion, which I'm happy to talk to you about offline, because we want to get into the technicalities that. So thanks very much for listening. Look forward to talking the next part of the hour.
Yes, thank you, Don. So we're going to move to Q&A. So again, please type your questions into the Q&A tool that you should find at the top left corner of your screen. We do have a number of questions coming in already, so I think we could get started. Related to the retirement question or topic and how you've moved your retirement account, and do you know what the returns are versus what they could be, the S&P 500, or what the returns would be if they were elsewhere?
For me personally?
Yeah.
Yeah, I mean, my returns at this moment are close to zero because I'm almost entirely in cash because I haven't been able to, I haven't created a strategy yet, and there aren't that many options of what you can do through your retirement funds other than a self-directed IRA, which I have invested in RSF Social Investment Fund. So I'm working on it, and I would say that this leads to a broader topic, which I'd love to get into, around people seeking market rate returns, you know, quote unquote market rate returns. And yeah, I'm always asking the question, if we're acknowledging that we've been participating in the extractive economy for a long time, and that one's financial returns on their investments are based in part on externalities, you know, on their investments, either related to the environment or the ecological side of things, or on the people side of things, then why should we expect market rate returns if we're trying to heal that? Is a question that I'd love to dig into, which we get into a little bit today, but if we don't get into enough depth on it, I would just say as a placeholder that I just went to a conference in Chicago last week, an Impact Capitalism Summit, where the steady drumbeat was you should have to give up nothing in terms of financial returns, or else it's not rigorous, real investing. And I think that's an interesting assertion because for a lot of reasons, I feel like the annualized returns we've gotten on all of our portfolios since World War II have been propped up by a lot of unexamined assumptions.
Mm-hmm. Yeah, and we had a question come in that was very much to that point, which is asking, will embodied investing be competitive, you know, against more mainstream financial investing in terms of return? And
yep.
Are there any studies or current comparisons
mm-hmm.
that you know of?
Yeah, I recommend going to the U.S. Social Investment Forum website, the USCIF website. They have statistics where the lines on the graph have crossed now, where they started tracking this, I think, in the late 80s or early to mid 90s, and for a while, if you were to invest in screen mutual funds, you know, to screen out, you know, tobacco, firearms, other things you don't like, or you were investing in what's now called ESG mutual funds, which stands for environment, social, governance, you know, positive. Instead of just screening out the bad, ESG is finding the good to invest in. Either way, if you were to invest in those funds, you would have made a smaller return on your investment up until very recently. And now it's become on par. Again, you can go to the U.S. Social Investment Forum website to see the studies. And a lot of people think that in the future, in a world where we're moving to more regenerative economy overall, that companies will be rewarded for that. And I was thrilled to hear recently from Paul Hawken, who's been working with the Interface Corporation for 20 plus years. This is a carpet maker, a publicly traded manufacturer of carpets in the Atlanta area, led for a long time by Ray Anderson, who has since passed. And he said in 1995 or so that by 2020 they were going to be net neutral or net positive in terms of their contribution to the grid, in terms of their energy, and in terms of their overall ecological footprint. And it turns out they're going to reach that milestone by 2018, a couple of years ahead of time. And so Interface, if you want to research Interface Corporation, you can see an example of a very large company that made a commitment, has made the changes, and is now showing that within their company, they are making more money now by virtue of turning their waste into energy and all the other things that they're doing. And I think in the future, even 10 years out, we'll see a huge multiplication of interface corporations, in which case all of us will have the benefit of being able to invest in those companies. So I think this is not like a fad. This is what's going to happen. So I think on the returns thing, but I don't think, I still believe in what I said before, that if you really want to go a step deeper, a couple steps deeper, and be a pioneer in this field, which I assume everyone on this call is striving to have that be part of their identity, to try and like push this whole thing forward. In the short term, you might not make as high returns, but if you make I don't know, 5.2% instead of 6.3%. I guess the question, you have to go back to, what is that going to limit you towards in your life, and is it worth it? Is that trade-off worth it? So longer topic. Yeah.
Okay, thank you. So shifting away from the financial return question and focusing a little bit more on impact. This question is, how does one monitor hopes for an impact investment versus the actual outcomes, if they aren't what you expected, or if there's unintended consequences? So essentially, what are your thoughts on how one adjusts for making bad calls?
Yeah, that's a great question. We have here at RSF, we do, to date, we've done mainly lending. And so each loan has a term. And if we find that the promise that the entrepreneur or the management team was making around their social environmental practices are not living up to what we had hoped, or even what they had hoped, we'll term out that loan and put the funds to use towards others who are able to achieve what they or we think are going to achieve what they or exceed what they are aiming to do. And we use the B impact assessment, which is open source on the B Lab website at bcorporation.net with every prospective borrower, and every year they have to fill it out again as one way of tracking how they're fulfilling their impact. And you all could do that with your direct investments. You could require the companies that you're investing in to do the same. That would be one way. There's no other questionnaire or survey to use that I know of that's been nearly as well thought out for small to medium-sized privately held companies to use in this kind of assessment. But in terms of like, if you're making an equity investment and you own shares in the company, then you're in it. You're in it to win it. And so you need to figure out if there's a way to sell those shares based on disappointment you might have about the lack of social environmental impact you're hoping for, or you look at it as an opportunity to keep digging in and trying to push things further. That's often good. And then the key would be to do an analysis, as you're getting into that feeling of frustration, of how best to avoid it in the future. It's sort of maybe the obvious thing to say, but we do a lot of that here. We do kind of postmortems on, how do we be the best financial partner we can be, even when it's not going according to plan. And then afterwards, if it didn't go according to plan, what exactly could we try to avoid next time, or what went into our decision making that we could shift?
So this next question is from a foundation. Can you recommend resources for small foundations looking to, and they use the term D Street, so essentially moving away from Wall Street or mainstream investing?
Sure. So let's see. I would recommend going to the website of Confluence Philanthropy. They're a great network of family foundations and other investors who are grappling with all these questions. If it's a family foundation, I mentioned Tonic earlier. I'm thinking about networks that we know that are particularly effective.
Community Foundation Circle.
Yeah, we hosted the last couple of years with Bali, the Business Alliance for Local Living Economies, a peer learning circle with about 20 community foundation leaders from around the country. And we're going to be starting another cohort of community foundation leaders in October. That if you're a community foundation leader out there, or you know of, or you have a donor advised fund at a community foundation in your region, you should know about this, because the first group, it was extraordinarily successful in the sense of building best practices and peer learning and peer sharing. So that's been something that we've hosted. There are lots of follow up with us afterwards. We can send more links than that. Those are a few to get you started.
So this next question is about the different sort of terms and opportunities in the space. So do you see blurred lines between ESG, impact investing, and SRI? And do you feel the adoption of these types of investment practices by large institutions will diminish the original guiding principles that these practices were founded on?
That's a really good double question. So on the terms, we try to be pretty agnostic on the terms. Like we frankly don't like the term impact investing. I'll just say I don't personally, and we're going to try and use it less because it's just not as specific as something like regenerative, and so if you go to the Capital Institute website, you can download a white paper by John Fullerton on that subject that I may have also cited at the call, this past fall, called Regenerative Capitalism. And so we're not looking to anoint another term or, but impact is in our favorite. With ESG and SRI, I feel like, it's sort of good enough, to get across. Whenever you read articles in the mainstream press, like the Wall Street Journal, where they make, ESG or SRI seem like this fringe, hippie thing, I think that's the critiques of it are sounding tired now because so many people want this, and I feel like it's going to kind of take care of itself. So a bunch of the naming, and then in terms of the co-opting by big players, the way I feel about that, I'll just do my quick spectrum here. So think of it this way: like on the left side of a spectrum, you may have someone like Morgan Stanley that has their sustainable investing, platform. And some of that may strike some of you as being kind of impact investing light, and possibly even like impact investing washing. I think it's great. We saw last summer that a boutique impact investing advisory firm called Imprint Capital got bought by Goldman Sachs. One of the principals in Imprint worked here at RSF for a long time before starting Imprint, and there was a collective feeling of kind of disappointment in some ways, but actually that was perfectly in keeping with their theory of change, which fits for the Morgan Stanley example too. That we have to, there has to be a place to go from like thousands to millions, when it comes to this whole impact investing thing. And I feel like that's an entry point that's just going to be a lot easier for millions of people to get on board with, the Morgan Stanleys and the Goldman Sachs of the world. And then in the middle, you've got like, say, Tonic, which is a phenomenal, learning community that's going even much, much deeper. I feel like this is my own, sort of lens on a lot of these questions, and is a real resource for people in terms of peer learning and really transformative learning. And then, it's getting more direct and more, and then you have maybe RSF even farther to the right, asking things, questioning assumptions even further. And so my point is just that I don't think it's a negative that the big financial institutions are getting into this. My great hope is that people who enter there will continue their learning journey and ask more and more and more and deeper questions about the core assumptions of how things work, and then either bring those organizations along with them as they go deeper in that inquiry, or they find organizations that are farther out for them that can serve them in a different way.
Yeah, and definitely more opportunities for direct relationships and kind of true partnership as you move across the spectrum.
Right.
You're not going to get that on the far left.
Yeah, at the end of the day, thank you. That like on the far left, there's still transactions. They're still ultimately opaque and anonymous, even if they're more aligned with your values. Whereas the farther you go towards the right, the more direct and personal it gets. Yeah.
What investor resources are out there for direct public offerings?
Good question. So there's a group called Cutting Edge Capital in Oakland, California. John Kadovich and others there, who some of you know, they're well versed in this area. Jenny Casson is doing her own work now, and is formerly with Cutting Edge Capital. Is also one of the more experienced people, in the country on this topic. And Casson is spelled Kassan, Jenny Casson. If you want to Google her. We work some with in fact, they're going to be here later this week for a brown bag with us, the Sustainable Economies Law Center, which is actually also happens to be in Oakland. These are some groups that are at the leading edge of direct public offerings. And then we ourselves have participated in, say, People's Community Market, again, in Oakland. That's a direct public offering that we participated in. And we've, so if you have questions about it generally, you should give us a buzz. And we can, put together maybe more of a resource list. And then if you want more on like the technical and legal aspects, call, Cutting Edge or Jenny Casson or Sustainable Economies Law Center. Yeah,
and if any of you on the call are not familiar with the term direct public offering or not exactly sure what it is, Cutting Edge Capital does have a good explanation. They have a video and then some more resources on just understanding what that means, both as an opportunity for an entrepreneur to raise funds and then also as an investor to get involved.
Can I name one other thing related to that? One thing, when I mentioned the community foundations creating their own direct loan funds for social enterprises, another phenomenon that's happening is that individual people are banding together in their communities, whether it's through slow money networks or just on their own. Like I'm familiar with an initiative in Bozeman, Montana right now, where there's a small group of individuals who are creating a small fund that will be able to be somewhat diversified and be solely focused on supporting small and medium-sized privately held companies with loans and equity in the greater Bozeman region. And so it's very encouraging to see that happening. So we'll continue to be tracking with who those folks are that are popping up and do posts on our website or other places have resources available.
Great. There's a number of questions coming in about specific opportunities, which I don't think we really have time for, and some I don't know that we're necessarily that familiar with. But I think this question might help, which is, are there resources to help provide people with due diligence tools, or what are best practices that they can apply to sort of any opportunity that they might come across?
Yeah, that's a really great question, and that's coming up all the time right now in all of our travels here. And just a couple of anecdotes. Carol Newell is a wealthy individual in Vancouver, British Columbia, who decided 20 years ago to go 100% impact, before that term existed, with all of her investments. And she worked with someone named Joel Solomon, who's been a senior advisor here at RSF for a long time, and who many of you probably know. And Joel was like her point person for doing diligence on the literally hundreds of direct investments that they made over the course of 20 plus years in the province of British Columbia in Canada. And there's no question that those two, along with others who worked with them, were the, if you, anything that you see in Vancouver that's related to there being a more just and sustainable economy can be attributed to renewal funds and the Enswell Foundation, which were the combination of entities they used. And so now, more close to the present moment, someone who worked here for a long time as head of our lending group, Esther Park, is now leading, a small organization called Cienega Capital, where she is doing diligence for someone who's a high net worth individual on direct investments and funds. And so this, of course, is an option that's available for someone like Carol Newell, or someone like the person that Esther is working with. Everywhere I go, people say, like, I need a Joel, I need an Esther. And what I think is going to happen is that there are going to be people like Joel and Esther who are basically going to train the next generation of integrated capital specialists or impact investing, diligence people. And we ourselves are going to host and convene and be a part of training that next generation of integrated capital specialists. And we're developing a program as we speak to do just that. And so more TBD, but essentially we're going to create like an academy for that here at RSF, and the people who currently work here on staff are obviously we work with them, and we don't want any of them to leave, so don't call us recruiting our people. But anyway, I think this is a great question, and there's going to be a lot more need for people who are really skilled at doing diligence, and hopefully there'll be people who can work with numerous folks at once, so you don't have to have like a dedicated, it won't be as expensive. There's a whole bunch of issues there, but yeah.
So going back to the embodied investing piece, the question is basically how do we help people, or how can people even help themselves dig into their values and spirituality and actually connect them to their investments?
Mm-hmm. Yeah. Well, here I think, in the interest of time, here's what I would say, and happy to talk about this more with whoever's interested, if you want to contact us and me after. I think the most important thing is not to work backwards from what your financial advisor is saying is possible. And because what you're, not that financial advisors are bad people, that there are gazillions of amazingly well-intentioned and capable financial advisors who have your best interests in mind. And there are certain constraints that are out there, some of which we've touched on in this call. And I think the first step is to really go through a process, and Leslie Christian in Seattle, LeslieChristianFinancial.com, has, is one person who has a methodology for how do you first go really deep on what your assumptions are about the world, what kind of world you'd like to see in the future, and what kind of healing you think is required in the world, and then to work gradually but steadily back up towards what kind of asset allocation and portfolio strategy you could have. And so that's what I'd say. That's quite vague and possibly obvious, but I think there are going to be more and more, as I mentioned with this tonic report, there are going to be 50 people who have volunteered to transparently share what their portfolios look like, who have gone through this process over a number of years. And I think, what I would imagine for each one of them, it started with like a real deep dive on what do they care about most, and then how does that translate into something that they could invest in, as opposed to working backwards from like a menu of mutual funds. So that's what I'd say for now.
Kind of a quick question going back to the title of this webinar. How are you defining Wall Street?
Yeah, that's a great question. So it isn't the top 6 or 7 banks, that each have, $2 trillion or thereabouts on their balance sheets. I mean, these are the big banks, names that we know, who have been engaged in some bad behavior. Let's just call it what it is. Over in recent years, and have embraced too much risk and too much opacity and so forth. And but that, to me, Wall Street, more so than specific institutions, certainly not to me when I talk about it in a negative sense. It has nothing to do with the people who work in those institutions. It's more around what we've accepted as a culture around money, and the idea that it's okay for there to be this, flash algorithmic computerized trading that supposedly creates more liquidity in the market that we supposedly need. And just all the culture around that, around it being a zero-sum game. Can I buy low and sell high? That becomes completely abstracted from people's lives and actual real economic activity. If you're just, trading stocks as fast as you possibly can and pocketing some minute share of the upside, it's gambling. Let's just call it what it is. So that's what I call Wall Street, is that gambling culture that we have, that individualistic culture that we have, that zero-sum game culture that we have around money.
Okay, we have 2 minutes. One question that you're not going to be able to answer in 2 minutes, but it's a good one. So if we all invest locally, as you were talking about doing, personally and as an approach, say within 100 miles of our homes, which is hard to do, but is a goal for some folks, would we not exacerbate the disparities between communities? So if you're if you live on the California coast versus if you live in the Central Valley of California.
Yep, that's a great question. So again, back to diversification, I think that for some people, if you're truly compelled to invest everything you have within 100 miles of your house, I think that's a completely valid proposition. Because you're really making a statement about the way you want your money to show up in the world in terms of relationships, and having a closer understanding of where your money is going. For many people, that's either not going to be possible or desirable in terms of the financial outcomes that you really want to have, say, for your retirement or what have you, and you may need to go farther afield. And so I think that it's really a balance, and I think that for most people, some kind of diversification is going to be really important. I just feel like now is a time, there's a window in time where it will be based on, say, either crowdfunding or projects even that we're going to be doing at RSF in the field of peer-to-peer lending. There are going to be more opportunities to come into direct contact with where your money is going and sustain a real relationship with the parties that are in the transaction. And I just am hoping that more people, I'm not hoping, people are already striving to do that. And I'm just hoping that we can keep modeling how to do that well, so that more people can do it.
Yeah. Well, it is 1 o'clock here in California. Thank you, Don.
Thanks,
and thank
Linda.
you for everyone who called in today. We had a ton of questions we didn't get to. Apologies for that. But if you go to our website, rsfsocialfinance.org, there is a staff contact list, so feel free to reach out. And if you're interested in listening to the webinar again or sharing it with others, it will be posted on our website in the next couple of weeks. All right.
Thanks all.
Yeah, thanks. Have a great
Have a good day.